Hi, welcome to my YouTube channel on long-term investment. It's about managing your money and securing your future. In our last video, we have seen what is the trend and candlesticks. And this video, we are going to see the type of candlesticks. So the different types of candlesticks which are defined as per their opening, closing or the wicks. So first is a Marubozu. Marubozu means close cropped or close cut in Japanese. Other interpretation refers to it as a barred or shaven head. In either case, meaning reflects that there is no shadow extending from body at either end, open or close. It means where the price opened, from that point onwards, either the price kept going up or kept going down. So this is the type of second black Marubozu, which means prices open at one end and after that it kept going down until the closure of the market. So there is a simple black body open at one end and close at other end, which is a downtrend. So black Marubozu is a long black body with no shadows on either end. This is considered an extremely weak line. It often becomes part of bearish continuation or bullish reversal candle. So where it appears, based on that the pattern is said. Next, white Marubozu. A white Marubozu is a long white body with no shadows on either end. This is extremely strong line when considered on its own merits. Opposite of black Marubozu, it often is the first part of bullish continuation or bearish reversal candle pattern. It's sometimes called major yang or Marubozu of yang. So it's like prices open at one point and from them prices just keep going up until the closure of the market. So it appears as a one white candlestick. Then this is the closing Marubozu. A closing Marubozu has no shadows extending from close end of the body, whether the body is white or black. So if the body is white, there is no upper shadow because it's like a market open at one end and then the security or stock kept going up until the closure. So that is the white Marubozu. Likewise, if the body is black, there is no lower shadow because the close is at the bottom of the body. So if it is a black Marubozu, the market will open at one part. The prices might slightly push up and then they will start going down until the closure of the market. So it appears like the candle with top wick. If in case of white Marubozu, it is exactly opposite of that. Then opening Marubozu. The opening Marubozu has no shadow extending from open price end of the body. If the body is white, there will be no lower shadow, making it strong bullish line. The black opening Marubozu with no upper shadow is a weak and therefore bearish line. The opening Marubozu is not as strong as the closing Marubozu. Then this is the second type of candlestick, spinning tops. Spinning tops are candlesticks line that have small real bodies with upper and lower shadows that are greater length than the body's length. This represents indecision between bulls and bears. The color of the body of spinning top along with the actual size of shadow is not important. The small body relative to the shadow is what makes the spinning top. So this kind of candlestick happens when there is an indecision between bulls and bears. The bulls start pushing up, but again at certain point price will face the resistance and sellers will come and it will come down. So this is why it looks like spinning top. So that's why it is called spinning top. Then this is doji. This is also very important candlestick. When the body of candle line is so small, body, we are not talking about the shadows. Body of candle line is so small that opening and closing prices are equal. They are called doji. A doji occurs when the open and close for that day are same or certainly very close to being the same. So you can see there are three types of dojis shown in this figure: gravestone, long leg and dragonfly doji. Long leg is doji. This is the figure 2.8 which is shown below. A long leg doji has a long upper and lower shadows in the middle of the day's trading range, clearly reflecting the indecision of buyers and the sellers. Throughout the day, market move higher and then sharply lower or vice versa. So it then closes at the very near the opening. So this is the long leg dojis. Then gravestone doji. A gravestone doji shown in figure 2.9 is another form of doji day. It develops when the doji is at or very near the low of the day. It is like prices open at one end, they keep going at the higher level, and after that reaching the higher level, seller comes in and they push the prices at the same level where it opened. The gravestone doji, like many Japanese terms, is based on the various analogies. In this case, the gravestone doji represents the grave of those who have died in the battle. So it's like those warriors who have tried to push the prices up, and then the sailors came, bears came, and they pushed them down. So that's why it's called gravestone dojis. If the upper shadow is quite long, it means the gravestone doji is much more bearish. Prices open and trade higher all day long only to close where they open, which is also the low price of the day. This cannot possibly be interpreted as anything but the failure to rally. The gravestone doji at market top is specific version of shooting star. We'll see the shooting star in next. The only difference is that shooting star has small body and the gravestone doji, being a doji, has no body. Some Japanese sources claims that gravestone doji can occur only on the ground, not in the air. This means it can be bullish indication of the ground or at the market low, not as good as bearish one. It certainly portrays a sense of indecision and a possible change in trend. This is very important. The last four lines, that some Japanese sources claims that gravestone doji can occur only on the ground. And when it appears on the ground, like if there is a downtrend along the way, and this kind of candle when it appears, it is usually the bullish indication. Next 3 or 4 days, that resistance will be broken. This is the first day when the bulls tried to push the prices up and the sellers came and they pushed the down, but that resistance will not hold for some time, and after 2 or 3 days you will see that the price is shooting up above over the top of the gravestone doji's prices. So that is why it is called bullish indication. Next is the dragonfly doji. It is called dragonfly because it looks like the dragonfly. A dragonfly doji occurs when the open and close are at the high of the day. It is exactly opposite of the gravestone doji. This normally appears at the market turning points. This doji is special case of hanging man or hammer line. So this kind of candlestick will specifically appear at the market turning points. Let's say that there is a downturn going on, and at the end of the day, this kind of dragonfly doji appears. It means the trend is about to change for short term the period, and where it appears, this kind of candlestick where it appears during the trend, that way it is called either hanging man or hammer line. We will see it in our next slide. So this is the stars. A star appears whenever a small body gaps above or below the previous day's long body. Ideally, the gap should encompass the shadows, but this is not always necessary. A star indicates some uncertainty in the marketplace. Stars are part of many candles patterns, primarily reversal patterns. So here the star is the black body which you see beside the white body. This is called morning star, and this usually appears in the uptrend. When the market is at uptrend and there is a long white candle, and next day when the market opens, it opens gap up and it tries to go up for certain time and then it comes down, and this is a doji, but it is with small body, and this kind of doji is called stars. These are the paper umbrellas or hammer and hanging man. Umbrella lines have strong reversal implications. Two of the umbrella lines are called hammer and hanging man depending upon their location in the trend of the market. So let's say if there is a downtrend, and at the end of that trend, if the green candle appears at the bottom, then it is called hammer because it looks like an hammer at that point, and this is usually the reversal of that downtrend. If there is an uptrend and at the end of that uptrend the red candle appears, which is there, then it looks like the hanging man, and it is usually the end of that uptrend for certain time, and the stock either will go in the sideways or in the downtrend for short term. Remember, all these patterns are not the long term, these are very short term. These are for 1-2 days to 5 days period. So This is only for the technical analyst, the swing trades or the people who are trading for short term. They use this for the indication for their change of their trends or change of their positions. So various candlesticks that we have seen now, big white candle, big black candle, doji, dragonfly doji, gravestone doji, hanging man, hammer, inverted hammer is nothing but the opposite of hammer, inverted black hammer, spinning top, shaven head, shaven bottom. So these are the certain various candlesticks names which Japanese have given based on their appearances and where they appear. Today we have seen the types of candlesticks, and in our next video we will cover candlestick patterns, and second is support and resistance. So without support and resistance, patterns will not develop, a trend will not develop. So support and resistance is very important. Even in our future long-term investment journey also, this is the most important topic. So please keep watching my videos. Thank you. Thank you for spending your time, and please like it, subscribe it and forward it to your friend. Thank you very much.